90% of active fund managers fail to beat the S&P 500 over a 10-year period. They have billions in assets, armies of Ivy League analysts, and supercomputers, yet they lose to a simple index fund. But what if I told you that a coldly mathematical approach using just 3 specific variables has consistently crushed the market for the last 2 decades? No emotional stock picking, no reading endless earnings reports, just raw data. The financial industry profits from complexity. They want you to believe investing is a mystical art that requires their expensive management fees. They sell you black box algorithms and artificial intelligence buzzwords. But the reality is profoundly simple. Today, we are tearing down that illusion. We are going to examine a purely quantitative framework. It relies on 3 specific macroeconomic factors. When these 3 variables align, they create an asymmetrical risk and reward profile. This profile historically outperforms the broader market by a massive margin. So how does this algorithm actually work? Let us break down the logic. The first variable is free cash flow yield. Wall Street loves to focus on earnings per share, but earnings can be easily manipulated. Net income is often just an accounting fiction. Cash, however, is absolute. Our algorithm isolates companies in the top decile of free cash flow yield across the market. Why is this critical? Because companies that generate massive surplus cash fund their own growth. They buy back shares during downturns. They survive high interest rate environments without relying on expensive debt. If a company cannot generate actual cash flow, it is a speculative gamble. We only deal in certainties. The second variable measures capital efficiency, specifically the spread between return on invested capital and the weighted average cost of capital. This is the true engine of compounding wealth. A high cash flow means absolutely nothing if management destroys value when they reinvest it. We apply a strict filter for companies generating a spread of at least 8%. This proves they are creating real economic value. They are not just expanding for the sake of revenue growth. Does the company make more money from its investments than the capital costs to fund them? If the answer is no, the algorithm immediately throws it out. There is no room for capital destroyers. The final variable is the momentum overlay. Fundamentals tell you what to buy, trend tells you when to buy it. Value traps exist everywhere in the market. A company can have great cash flow, but see its stock bleed out for years. By applying a strict technical rule, we avoid this trap. The algorithm only holds these high-quality stocks when they are trading above their 200-day moving average. This eliminates dead money. When the structural trend breaks down, the algorithm automatically rotates into short-term treasuries. This cuts maximum drawdowns in half. It protects your capital during systemic market crashes. It is pure mathematical defense. Free cash flow yield, the capital efficiency spread, the momentum overlay. This is not a secret Wall Street trick. It is systematic, ruthless risk management. The math is incredibly clear. The S&P 500 is a fantastic benchmark, but it is heavily weighed down by bloated, capital-destroying corporations. You do not need to outsmart the entire market to win. You just need to follow the data. Remove your emotions, stop trusting the narrative, stay rational, and let the logic dictate your capital.